Hello financial fans, welcome back to another stock analysis. Today we'll be covering UnitedHealth Group, stock ticker UNH. UnitedHealth Group is a diversified healthcare company that provides a wide range of healthcare products and services. The company operates in two segments, United Healthcare, which provides health benefit plans and services, and Optum, which provides information and technology-enabled health services. United Healthcare offers health insurance products including medical, dental, vision, and prescription drug coverage, as well as Medicare and Medicaid plans. The company also provides employer-sponsored health plans and individual health insurance policies. Optum provides a range of health services including pharmacy benefit management, healthcare consulting, data analytics, and technology solutions. Optum also operates a network of urgent care centers, surgery centers, and behavioral health facilities. They are currently sitting at a $446.4 billion market cap, and their revenue in 2022 was $324.2 billion, and the dividend yield is sitting at 1.38%. 80% of their revenue comes from premiums, 12% from their products, and 8% from services. To determine the final valuation of the stock, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 25% that can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two metrics that we'll be using are the EBIT growth and the margin growth. The EBIT has gone up, going from $5.6 billion in 2013 to $20 billion in 2022. The average EBIT growth during this period was 15.9% annually, which is a 5% decrease in the margin of safety. The margin has also gone up, going from 4.6% in 2013 to 6.2% in 2022. The average margin growth was 4.1%, meaning a 5% decrease in the margin of safety once again. The next two ratios are the dividend growth and the payout ratio. The dividends have gone up, going from 85 cents a share in 2012 to $6.60 a share in 2022. The average growth in dividends during the period was 20.5%, meaning a 10% deduction in the margin of safety. This with a payout ratio that's sitting at 30.2%, which in this case is no change in the margin of safety. The following two ratios that we'll be using are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of EBITDA it takes for the company to pay off all of their debt in years. In this case, UnitedHealth is almost 1 year of EBITDA. In this case, a 95% debt to EBITDA ratio, meaning a 5% deduction in the margin of safety. The return on invested capital for UnitedHealth is sitting at 10.6%, meaning no change in the margin of safety. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. I've imported free cash flow of UnitedHealth, going from 2013 to 2022. The average growth rate in free cash flow annually during this period was 17.71%, and I'm projecting an expected growth rate in free cash flow of 10% annually over the next 10 years. With this percentage, we can determine the future free cash flow of UnitedHealth and determine the terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 9%. This gives us a sum of free cash flow of $620 billion, and to get our equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of almost $591 billion. All that's left to do to get a discounted cash flow price per share is to divide it by the amount of shares outstanding, giving us a price per share of $633.54, which is a 32.38% upside of this model. The second model that we'll be using is the discounted cash flow model. I've imported the dividend payout of UnitedHealth going from 4 years ago to the current year. The average growth rate in dividends during this period was 16.38%, and I'm projecting an expected growth rate in dividends of 8%. I will once again be using a discount rate of 9% in this valuation, giving us a discounted dividend model price per share of $712.80, which is a 48.95% upside of this model. The third model that we use is Graham's revised valuation formula. In this model, we look at the earnings per share that UnitedHealth is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the standardized yield of AAA corporate bonds. And we go by the theory that a company with no growth is always sitting at a PE of 7. And looking at all of these metrics, we get a fair value of $399.56, which is a 16.51% downside from the current price. The fourth model that we use is the multiple valuation. In this model, we look at similar companies to UnitedHealth, look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is 22.59. All you have to do is to multiply by the earnings per share that UnitedHealth is generating, which in this case is $21.34 a share, giving us a fair value of $482.01, which is a 0.72% upside out of this model. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metric that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of UnitedHealth of the past 5 years, and the average yield during this period was 2.34%. Meanwhile, the current yield is sitting at 1.39%, meaning that it's currently overvalued on this metric. The PE ratio of the past 5 years was sitting at 23.21, while the current PE ratio is sitting at 22.43, meaning that it's currently slightly undervalued on this metric. This gives us a fair value of $389.98, which is a 18.51% downside out of this model. If you want access to all of the models that I use in my videos and more, you can check in the description for my Patreon link. Anyways, getting that self-promotion out of the way, let's go look at the final overview of our valuation next. Looking at our final overview, we've imported the discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $523.58 cents. Our margin of safety we've determined earlier, using a standard margin of safety of 25%, deducting it by 5% for the debt to EBITDA, 5% for the EBIT growth, 5% for the margin growth, and 10% for the dividend growth, leaving us with no margin of safety at all. With this fair value then the same being as the average out of the models, with the current price of $478.56, we get an upside of 9.41%, indicating that it's currently a buy. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.